Good afternoon, everyone. We are Group 107. I'm William, and this is Ryan. Today, our topic is public attention and market movements, a perspective from Baidu Index and Shanghai stock market. So this is the agenda today. We're going to first go through the background and literature review, and then is the significance, motivation, and research questions. And then we're going to talk about the data and methodology. And then it's the findings, and then the interpretations of the findings, and then it's the trading strategy, and finally we will conclude with the further research and conclusion. So as we all know that not all the investors are rational. So therefore we have behavioral finance. And in behavioral finance we have a very important concept called limit attention. Limit attention means that attention is limit resources for human beings so that not all the investors can pay the attention to all the individual stocks in the stock market. So investors tend to buy or sell the stocks they have paid attention to. And there are traditional processes of limit attention, including the newspaper headlines, advertisement expenditure, and appearance on the investment-related TV programs. However, this traditional process has been criticized as passive and indirect. And also, they disallow the long-term observations. And with the advancements of technology, we have Google and Baidu. And Google Trend is a product of Google that represents the search volumes of particular keywords. And similarly, we have Baidu Index. A Baidu Index also indicates a search values or search frequency of a particular keyword in Baidu. And there are several papers that have done the research using the Google Trend or Baidu Index. Generally speaking, a higher search volume of a particular stock will lead to a price rise in a very short period, but this price will eventually reverse in a very short time. So today, we're also going to study on the Baidu Index. But what we are different from that is that we're going to study on the market index, that's the market portfolio, instead of the individual stocks. And furthermore, we use a longer time frame, which is 4 years. And we also count the search volumes contributed by the mobile devices. And we're going to study the relationship between the Baidu Index of the stock-related keywords and the market index. And we will expect that the Baidu Index of keywords implying an upside market, for example, bullish, are positively correlated with upward market movements in the future, and vice versa. And if this relationship really exists, we'll construct a trading strategies that can make a fortune based on this relationship. So the market index we use is the Shanghai Stock Exchange Composite, which is also a dependent variable. And there are also other control variables, including the MSCI ACWI, and Shanghai Stock Exchange Composite Return, but it's on previous days. And the keywords, stock-related keywords that we have identified include limit up and limit down, good news and bad news, bullish and bearish, long buy and short sell, long position and short position. And we're going to use the Chinese meaning of these keywords. The reason we use this keyword is that their Chinese meaning are exclusive use in the stock market. And furthermore, there are sufficient data and they are in pairs. And we're going to accumulate the non-trading data, the data on the non-trading days to the last trading days. And furthermore, the up market keywords will minus the down market keyword. For example, the limit up will minus the limit down to represent a net data of the limit up. So this is my strategy. We have constructed 3 models. Model 1 with 1 day lag. And we have a Shanghai stock composite returns as the depending variable, but this return is on day T. And we also have the Shanghai stock composite return, but it's on the day T minus 1. And similarly, we have an MSCI return on day T minus 1 and Baidu Index on day T minus 1. And similarly, we have model 2 with 2-day lag, and the same dependent variables, and a slightly different independent variable is on the day t-1 and t-2, and NSCI on the t-1 and t-2, Baidu index on the t-1 and t-2, and model 3 is also very similar, but with 3-day lag. So here is our findings. For the limit up and limit down, and the bullish and bearish, these two keyword pairs, the data on the day t-1 are positively correlates with the Shanghai Stock Composite return on day t. And furthermore, their data on the day t-2 are negatively correlate with the returns of the Shanghai Stock Composites on the day t. And the data on the day t-3 has no significant result. And as for the other keywords, there's no significant result at all. For the control variable, the MSCI on the day t-1 data has a very strong positively correlates relationship across 3 models. And there's no significant result for the other variables. So now I will pass to the interpretation of the findings.
Thanks, William. So the finding of bullish and bearish is consistent with research done in several Western markets at individual stock level. So we actually have extended this finding from individual stock level to the market level. And the relevant European Central Bank working paper is in favor of the investor sentiment hypothesis. So when people search some information, they pay attention to it, and they will be affected by this information. So the searching volume actually represent the overall market sentiment, which will result in their investment decision and drive the stock price to move. The same explanation can be applied to limit up and down. But except for this, there is a stronger explanation rooted in this unique limit up and down market mechanism. So we can see through this by understanding how this mechanism will affect the market by strangling the liquidity. So let's think about the circuit breaker case in China at the beginning of this year. Circuit breaker actually amplifies the fear of illiquidity of the market because when the second breaker is triggered, investors cannot trade anymore within that day. But the desire of investors cannot be simply stopped by this mechanism. So when the first breaker is triggered, whatever it was going up or going down, investors will expect this trend to continue. So everyone wants to buy before others push up the price again, or escape from the market before the second breaker is triggered. So under the power of the public, the second breaker was triggered almost immediately after the cooling time of the first breaker. So this is the same case when it's in the situation of limit up and down. People will expect that the trend will continue on the second day. So that's why the Baidu index, which represents the aggregate attention on limit up and down, can in some degree explain the market movement. So, we have tested our findings on 5 pairs of words, right? There are 3 pairs of words that does not show significant correlation, and we have provided some possible explanation in our report. So here I will only talk about one of them. As for good and bad news, we may have to look into their Chinese meaning, which often refers to authoritative information. For instance, when People's Bank of China announced an interesting rate cut, this may be a good news for the stock market. But this kind of information, by its nature, is infrequent. So when we run our regression test on a time horizon as long as 4 years, the correlation is insignificant. We understand that many people, even some professors here, just don't buy the concept of behavioral finance. So what really matters is that what we can do with our findings. So according to the previous logic, we should be able to predict next day's market return with certain accuracy and trade accordingly to make a profit. So the first step is that from model 3 just mentioned by William, we obtain optimal models for limit up and down and bullish and bearish respectively. Then we use this optimal model to calculate predicted daily returns for year 2011 to 2014, arrange them in descending orders, divide them into decils, and the top decile is our signal window. And finally, we will calculate the predicted daily return for 2015, use brand new data in 2015. Our trading strategy is simple and elegant. When the next day's predicted return fall into signal window, we will just buy the stocks with all of our money at today's closing price. Or we'll continue to hold the stock if we already have them on hand. And otherwise, we will stay wait and see or sell the stocks on hand at today's closing price. So we first try to simulate our trading strategy on a theoretical setting, assuming that we can trade directly on SSEC index and assuming that there's no transaction cost. This is the cumulative return performance of our strategy and benchmark. Benchmark is a passive holding of the SSEC index from the beginning to the end. So in this summary of key performance, you can see that both our strategies will outperform the benchmark in terms of return and Sharpe ratio. Sorry for the typo. And for limit up and limit down, we can earn a cumulative return as high as 47% for last year. So you may say this is too theoretical. So we try to put it into a more realistic situation. This time the underlying asset is Dutch X Tracker, MSCI, All China Equity ETF. It's a real ETF in the real world. It's highly correlated with the SSEC index. And we can trade this index at China's midnight time, which is the earliest time that we can get the Baidu index of T-1. So this is a cumulative return of our strategies and the benchmark. The same for the benchmark is the passive holding of the ETF from the beginning to the end. So maybe because that we have changed our underlying assets and the correlation has been weakened, and we have taken into consideration the transaction cost this time. So the performance of our strategy has been compromised a little bit. But they still outperform the benchmark. And for limit up and limit down, we can earn a cumulative return as high as 18% for last year. So previous parts are the main content of our Capstone project. In the future, we may need to test our findings in other markets with limit up and down mechanism, for example, Korea, to make our findings more robust. And besides, we need to identify the most correlated tradable financial instruments so that the performance of our strategy will not be compromised. And finally, we want to further optimize our model with additional variables so that our prediction is more accurate. So to conclude, we have proved that the Baidu index of limit up and limit down as a direct proxy of public attention has very strong correlation with market movement. And we have constructed a trading strategy accordingly. Satisfactory results are obtained under both theoretical and realistic settings. And this is the end of our Capstone project presentation. Thank you very much.